Hi, I'm Sony Kapoor. I'm a professor of climate, geoeconomics and finance at the Robert Schuman Centre at the European Union Institute. Today, we are going to have a brief chat about the state of financial markets and how we might be entering a new regime. If you are watching the news, you will see that all around us, financial markets appear to be in a state of partial meltdown. Asset prices, particularly the S&P 500 index in the United States, has fallen quite dramatically since the beginning of the year by somewhere around 20% or so. Other asset prices, housing prices across the world, stock markets, and others are also starting to enter bear territory. Is this temporary? Is this just yet another downturn that will then be followed by yet new records being set by financial markets? Or could this time be different? And if yes, how and why? Well, I can share my thoughts based on my research, and these are as follows. Up until recently, there have been a number of structural trends that have put a lot of tailwind in financial markets, driving up asset prices relentlessly year after year, decade after decade, even when there have been a few reversals. The first of these is a secular decline in global interest rates, where we can use the world's most important interest rate, which is the US Treasury rates, as an example. So these have declined from about a real rate of 8% back in the 80s to closer to 0% now, with a few fluctuations in between. Now, every time an interest rate declines, the price of all assets rises, and that's because future cash flows for assets, whether it's rent or dividends, are discounted by the interest rate, the world's safe interest rate, which is US interest rates. So every time the denominator falls, the value of the cash flows rises, and that has been a huge driver in bidding up asset prices across the world, from art to fine wine to housing markets across the world, and particularly stock markets. Now these, as we know, are now in negative territory, where the real interest rate is negative because inflation is very high, of the order of 8% or so. And central banks are starting to react. The Fed has already signaled significant number of rate rises. The ECB has done the same. And this basically means that this downward-looking chart, which has inflated asset prices, is now at an end. Now, the exact reverse happens to asset prices when interest rates start rising. So the best case scenario for asset prices is that interest rates remain low, but we know that will not happen. The Fed is starting to raise interest rates. The markets are starting to price these in. So interest rates are starting to rise, which means what was a tailwind bidding up asset prices is now going to become a headwind that will push those asset prices down. The second important development has been a secular decline in corporate tax rates across the world. Of course, there's a few countries here and there where corporate tax rates have actually risen, but for the most part, since about the early 80s, corporate tax rates have just continued to fall. And every time that happens, the post-tax cash flow available from company profits is higher, and of course that means the value of the asset and the security is higher. Now there again, there was an international agreement to agree to a minimum corporate tax rate that is likely to be agreed on this year or next year, and already faced with serious yawning fiscal deficits in the face of large spending necessary for the COVID pandemic, countries are starting to raise corporate tax rates. And there again, the second big driver of what has led to a large increase in asset prices has now, at best, either stabilized and plateaued, or worse, is now starting to rise and go into reverse. The third big driver of rising asset prices has been quantitative easing. Close to $10 trillion of new money injected into the financial system by central banks, the US Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan. And of course, every time they inject new money into the financial system, that money is used to buy the existing supply of financial assets, which basically means, if you look at supply and demand mismatch, that it bids up the prices of all assets. And that's exactly what we saw. And there again, the Fed has clearly signaled that it will stop buying new assets and instead start actually withdrawing some of this quantitative easing and to go into quantitative tightening territory. The Bank of England and the ECB will likely follow. And there again, what has been pushing up asset prices, this new money being pumped into the system, more and more liquidity, will now at best either stop pushing asset prices up, or at worst, as the money supply slowly is tightened, might drag asset prices down. And last but not the least is a very benign inflationary regime where effectively real wages in the United States, in large parts of the EU, and definitely in the United Kingdom had stagnated, and corporate profit margins rose quite dramatically since about the early 90s. And a big phenomenon was that with China's entry into the WTO and integration into global trade, the size of the workforce engaged in globally connected supply chains increased very dramatically in a relatively few short years. And that meant that the relative supply of labor expanded and labor's bargaining power fell. And that meant that wages stagnated for blue-collar workers in the OECD in particular, even as Chinese workers caught up. And that allowed large corporate profit margins. There again, partly because Chinese demographics are starting to reverse, a lot of the increased accelerated pace of globalization has now potentially run into the end of the road with geopolitical tensions between China and the West. And China's zero COVID policies have led to large lockdowns disrupting supply chains. So there again, one of the big drivers of higher corporate profit margins, stagnating wages, etc., has potentially come to an end, meaning workers, particularly in the United States, blue-collar workers are starting to bid up their wages. So all of this basically means that what has been a fantastic golden age for pension funds, asset managers, sovereign wealth funds, anybody with money invested in financial markets, that golden age has come to an end. 2/3 of the dramatic increases in asset prices in the past 3 decades or so were driven not by the income earned in terms of interest or dividends or rents on houses, but actually came from an increase in asset prices pushed up by these 4 factors I described. We now are entering a new regime of much lower expected returns in bonds, in stock markets, in housing, and in other alternative assets. And this has dramatic consequences for pensions, retirements, and the availability of large pools of private capital to deploy, for example, in the green transition.